Hi, this is Kristen Heemstra with the College Admission Summit. And if you are somebody who has to or wants to help pay for your child's education beyond high school, it typically involves some planning. And so what we have here is an expert on planning, Clark Troy. Welcome, Clark.
Thanks very much. I'm happy to be here.
So rather than me doing a long introduction of you, the first thing I want to say about Clark is that he and I have both been walking in this space this year. We're both sending our first child off to college, or our first children have now enrolled and since gone off to college. So this is something that he and I have been knee deep in this year particularly. And so what we're going to do is cover the basics. So Clark, can you tell us a little bit about yourself, please?
Yeah, I am like you from Chapel Hill, North Carolina, and I am a fee-only financial advisor. And what that means is that I act always as the client's fiduciary, and that I am paid solely by my clients, and that I act in a very holistic fashion in trying to think through the full range of financial issues that come up for people, and that so not just investments, but planning for really whatever comes up in life. And what I have noticed in this business and just in life is that for most normal people, there are a few very common financial goals. People need to buy a house, need to send kids to college, and then eventually you want to retire, and you don't want to be in penury when you do so. So but figuring out how to do all of those things is pretty complicated, and people tend to come into our funnels, sort of start looking for someone like me once they've already sort of established themselves in a career, and so have already got a house and a mortgage and are paying for that, and then they have kids. And kids and aging parents are really the things that sort of make people sit up and start to think very differently about the future, and like sort of the length of the horizon of the future really becomes real when you have those things. And then when you start getting closer to those goals, it becomes clear that it's complex. There's a lot of nitty gritty in there. There's a lot of details in which devils can be found.
And we're going to go kind of broad in our conversation, but I would just like to say that having been through this process, my experience has been that it is not as straightforward, because you do have aging parents involved. You do have your house involved. There are a lot of moving parts. So let's just start kind of with the basics, Clark. If somebody, can you talk a little bit about the FAFSA and the EFC? Just kind of what are those things?
Sure. So the FAFSA is the financial aid form that all Americans need to fill out for any university that is acting as a conduit of and dispenses any kind of federal aid. And that means Stafford loans, Perkins loans, Pell Grants. There's a whole range of different federal programs that constitute the bulk of much of the financial aid that is available to most people. While you asked only about the FAFSA, but I think it's a mistake not to follow up the FAFSA by immediately talking about the CSS profile.
Absolutely.
So the CSS profile is another financial aid form, and that is used by, on average, more selective colleges and universities. It digs a little more deeply into a household's financial situation than does the FAFSA. And the rationale for that is that basically the more selective institutions are, on average, institutions that have some of their own money. So they have endowments, and they are using their endowments to fund the education of their students. And So since they are dispensing not just federal money, but their own money, they have to evaluate a household's financial wherewithal or they are incented to evaluate a household's finances in a deeper fashion than are schools that are strictly acting as conduits of federal aids. So they only use the FAFSA. So there are two, but if you apply to one of these more selected institutions, you fill out both the FAFSA and the CSS profile. So it's kind of it's a two-step dance for frankly, most of the people who will be taking the time to watch us talking today. There's a sort of self-selection process that happens whereby the people who are most heavily invested in their children's education are the ones who go out and educate themselves more about the process, and they're also there's a huge amount of overlap with those who apply to the FAFSA and CSS schools. So it's you need to have both of those concepts and both knowledge that there are two basic paradigms out there for financial aid distribution. So the EFC is the expected financial contribution, and that is the amount that a family is expected to provide to fund a kid sending their kid to college, basically. So basically for whatever methodology, be it a FAFSA only methodology or a methodology that employs both the FAFSA and the CSS profile to figure out a household's finances, a family will input information about their income and about their assets into one or both of these methodologies, and it will spit out a number at the end of it, which is the expected family contribution, the amount of families expected to contribute to the child's education. And that can include both amounts that the family is expected to borrow and also amount that they're expected to provide out of pocket.
And I think that that's really important to understand pretty well. I'm just going to talk about my personal experience. My daughter applied to a school. We had the EFC number, and the school came back with a combination of merit-based scholarships, which are really nice, as well as loans that they expected to make up part of it, as well as a work-study program. So it was an interesting package to see how they met took our information and then turned it into meeting the quote unquote financial needs of the family, or, so it doesn't, if you have a specific EFC, expected family contribution, and let's say the school is $60,000 and they expect you to be able to pay $30,000 a year. It doesn't mean that they're going to give you $30,000 to make up the difference in the price tag of the school. It may be loans, it may be other things. I just think that's kind of an interesting thing to understand prior to going into this experience.
Right. Although, depending on an institution's financial strength, there are, a need blind school will typically give you, grant-based aid to fulfill the family's shortcoming for the expected family contribution. So it'll say, if again, to use the example of a school that costs $60,000, and you're expected to contribute 30, the other 30 at a need blind school will typically be grant, not loan.
And so there are about a dozen need blind schools. Most schools are what's called need aware. So a need blind school typically has a very large endowment. And you'll see those are more the Ivy League schools, play in that space. A need aware school is going to look at your family's ability to pay for the education as part of the admissions decision. So they're not going into the process. They need to meet their bottom line. Never forget a school is a business. Always remember that. And if you do, then their decisions will make more sense to you. So let's say you have Yale knee blind or Princeton knee blind, and then you have NYU. NYU is going to come back more than likely with some type of loan or some, they'll tell you in their information session, students are working up to 3 jobs to help supplement that, their work study program in order to make the payments that they do. So, okay, so let's say you're a parent, and what's the ideal runway time in order to get, amass the amount of money, or what, let's just go even more general than that. What advice would you give to somebody who says, okay, here's little Susie or, Juan, and we want to pay for their schooling. They're a year old. Let's just go with a year old. What would be the general kind of map that you would advise anybody to kind of go through? Or what are their options? Let's start with that. What are their options of saving?
Right. Well, I mean, I think first and foremost, you don't want people to fall into the trap of saving only for college. The first rule of the road is to save for retirement before you save for college. And there's a couple of principles involved there. One is that you can borrow for college, but you can't borrow for retirement. So you really need to take care of yourself and make sure that your deep love of your child doesn't blind you to the financial realities of the fact that your child is going to, ideally, in most cases, is going to take flight and leave your household and go on to live an independent life of their own. And then you need to take care of yourself, because I think that there is a tendency for people to want to feel some guilt if they aren't funding their children. So the number one thing to do is to, as you are planning your saving, is to make sure that you are always saving as much as you can into your retirement account before you save for college. And I spoke to that on sort of the general principle of sort of long-term planning. There is also a technical reason for it, and that is that when both of the financial aid methodologies, both the FAFSA and the CSS, both of them exclude from family assets in retirement accounts. So whatever you have in your 401k, whatever you have in your IRA, your simple IRA, your SEP, etc., your 403b, is not included in asset available to fund college. So it doesn't count against you in the financial aid calculation. So therefore, you always want to fund those. Now, like once you've done that, start saving for college early, because it does cost a lot. The sticker price for for most private 4-year colleges clusters around $65,000 or $70,000 now, and if you're looking at out-of-state tuition for a good state college, and I'm talking, and when I say the total cost, that includes both tuition and housing and books and et cetera, expected costs. Looking at, again, out-of-state for a good public college can be $45,000, $50,000. So it is a lot of money. There's no question about that. So you want to start saving, but you should also understand that most people don't, in fact, pay the whole sticker price. Most colleges do offer some combination, or most is too strong. Most of your more competitive colleges, and again, most of the people who are likely watching this will have self-selected themselves into the cohort. where their kids are going to be competing for some of those schools. Most of those schools do have some money to help defray the cost of college, and the net price that most people pay for college is not the uh, is not the sticker price, but there is a discount. But you do want to save, and saving early is, the earlier you save, then the less that you need to save. So for a kid, I think that the ideal ramp time is to start, when your kid is born, or when your kid, at the very least, when they're in elementary school, if you can start putting some portion of your income away into an account that is dedicated for college savings, you're going to be ahead of the game. No question.
So I'm just going to talk about my personal experience. My children were born in Virginia, and Virginia has what's called a VPEP plan, which is actually open to everybody in the United States. When my oldest was born, we were able to enroll her right away. And the VPEP allowed for us every month, it took a portion out of our income. And then what it was saving for, which I didn't realize, I thought it was going to cover tuition, room and board, but it only covered tuition. But now that she's in college, we've been able to pull some of that money out, and it was saving for Virginia school as we were Virginia residents. So that's, I know, one way. And then with my other child, we started her with another 529 kind of product out of Virginia, called the Vest product. And so, and again, it just takes money out each month. But it's not quite the same. So those are two that I'm aware of, and I'm sure there's a slew of them out there. Do you have any general comments on 529s or thoughts about those?
I think that 529s are good products. A 529 basically is an account that into which one puts after-tax income. So the basis of that goes into the account is never taxable. So let's say over the course of 10 years of feeding a 529, you put $100,000 into it. Well, assuming that it increases in value, there's never going to be any tax on the $100,000 in basis. The gains on the account are not taxable if they are used for a qualified higher educational expense. So for tuition, room and board, books, computers, sort of basic expenses that everyone is going to incur in going to college. So long as you can document the fact that, excuse me for 1 second, forgot to turn off my phone. So long as you're able to document the fact that money taken out of a 529 was used for qualified higher educational expense, it's not taxable. So yes, each state has a 529, each okay. Plan that is, the states contract with different mutual fund companies and and other custodians to offer 529 plans. For some states, there is a tax reason to prefer to be in your state's 529. That's really on a state-by-state basis. It's governed by state law. Here in North Carolina right now, there is no longer any tax reason to prefer being in our state's 529 than in any other state's 529. There are a lot of good 529s out there. I use the Virginia College America plan, as well as the state of Illinois' Right Directions plan, but a lot of people like the Utah plan as well. So there's lots of, there are lots of 529s, and there are ratings systems available for them online. One can do a lot of research on them. But by and large, one has to investigate on a state-by-state basis based on where you live, whether there is a reason for you to prefer your state's 529.
So that's at least one way that you can kind of start pulling together money in a very early stage. Uh, One thing I do want to comment on, the numbers that we've thrown around have been for fairly selective private schools. Your state school is always going to be cheaper than an out-of-state school. So, for instance, it's less expensive since I live in North Carolina for my children to go to school in North Carolina because I've paid into that tax base the entire year. Uh, and then also, if money is really a factor, you can look at the community college level. There's great community colleges, and those that you pay for those by the hour. So in a, let's say, a state school like UNC Chapel Hill or any of the UNC schools, you typically send your child to college. So they go, they pay the tuition, they pay the room and board, they live there, they eat there. It's a whole experience. If you do a community college, it's much more streamlined. You live at home or, wherever you want, you pay for your own meals, and all you pay for are the credit hours. And those, I've been in all institutions. I went to a community college in between my undergrad and graduate work because I needed to get 2 or 3 credits that were aligned with the graduate degree I wanted. And they're great learning experiences. I really enjoyed my professors. I really enjoyed the whole experience there as well. So there are lots of ways to get the education you want. And now there's even online. I mean, there's just so many. So as we're having this discussion and throwing these numbers around, I just want people to know that there's always a road. there's the, just various ways to get where you want to go. So Clark, in addition to a 529, you can pay out of pocket, obviously.
Sure.
What other kind of general strategies would you say a lot of people that you've seen other people use in this space?
There are people who tout the benefits of using different types of life insurance products for college savings. I tend not to favor them. I think that the costs associated with the life insurance products tend to outweigh their benefits. Plus, there are negative consequences for when you extract money from a life insurance policy to make a payment for college. It is basically there are a number of products, including life insurance policies, as well as Roth IRAs, or even in one other way that many families save money for their kids is for grandparents to fund 529. So those are 3 categories of vehicles where money can be parked for college education, where when you fill out a financial aid form, most of the time, and I say this because the sands are always shifting in what individual institutions are looking at, and particularly with regard for grandparent 529s, but for whole life insurance policies or for permanent life insurance policies, so for whole life or variable life, or for a Roth IRA, or most of the time for grandparent 529s, a university isn't going to see it when they're asking you to list out your assets, so it doesn't count against you. However, the year after you've taken money out of one of those vehicles and used it to pay for college, in the subsequent year, it will appear as income to your child. And on the college financial aid applications. So at that point in time, it does negatively impact the aid that's available for a child. So for those reasons, I'm not as big a fan of those vehicles, with the exception of the fact that because of the way the timing of the financial aid application process works, it currently looks 2 years back at a prior year tax return. So these can be good if you can manage your college payment strategies. These types of vehicles are more useful if you can use them to fund only the junior and senior year that your kid is in school, because at that point in time, because of the timing of the methodology, it's no longer will count against your child. Basically, the tax returns for those years are never taken into consideration for when looking at how much financial aid is available to your kid. So, those I would say are, the most favored strategies. You can also use a Coverdell, which is an older type of product, a Coverdell or an education savings account, which is an older type of product, which is like a 529 in many regards, except for you can own any kind of security within it, stock, bond, mutual fund, ETF, but you can only put $3,000 into it a year, so it's a limited utility unless you can start planning before your child is born,
Right.
which is kind of hard. Yeah, those are people who plan that far in advance are few and far between.
Like
I haven't met any of them.
Fun for my non-existent child. Very good. Just kind of in closing, any last minute, things that you've observed that have worked well for people or haven't worked well for people, and any last minute thoughts or anything like that?
I would say, just first and foremost, that the thing that doesn't work well for anyone is waiting until your kid's in ninth grade. If it's ninth grade and you're just starting to think about funding college, then you've created a problem for yourself. And if you make a lot of money and you can pay for your kid out of cash flow, and your assets were such that you were never going to get any need-based aid anyway, then it doesn't matter. But that's just not true for most people. For most people, it pays to think about this beforehand, and this, the sooner the better. So, yeah, start early. Start thinking about it early, or educate yourself, read up on it, reach out to someone like me or Kristen, and ask for help. So if you're watching us today and your child is in elementary school, then pat yourself on the back, particularly if it's early elementary school. If your kid's in, sixth or seventh grade, all is not lost by any stretch of the imagination. And I think that the good news is that most people have to get integrated into this thought process. People who have multiple children learn about it with their first child. So if you learn about when your first kid's in seventh grade and your second kid's in fourth grade, and your third kid's in second grade, then for your later kids, you're better educated about the process. So, but educate yourself. That's my word of recommendation.
Yeah, no, that's great advice. I will say too, if you are late to the game and you didn't save the way you wanted to, there are several types of loans that are available to you. One of the loans is offered by the government. It's a small loan. It's like $3,500 a year, but it's still something. And that loan is through the government, so it gives you a lower percentage rate. And it's Sallie Mae is kind of the arm of the government that handles this. But then there are also private loans for college. Those loans, you really want to be thoughtful about them the same way you're thoughtful about a mortgage on your home. They have some loans don't have fixed interest rates, so that means that they ebb and flow with the economy, and you can really get yourself into some trouble with those. And we do know, there's a lot of college debt out there right now. If you go through this process, you will be put through kind of a loan counseling thing that the government requires you go through. And that's super interesting because they show students who often have their names on the loans what the final price is. And so it's one thing to say, oh, I'm going to take out, I'll just pick a number, a $20,000 loan. It's another thing to then say, wow, my $20,000 loan actually balloons into, $47,000 by the time I make all the payments on it. So they will walk you through that process, but do be very, very thoughtful. There's a lot of people who would like to give you money because they make money from you, but there's really smart ways that you can get an education without having to do some of those things. So.
That there are.
So, all right. Well, Clark, thank you so much. And Clark's information, as you can see, is below, and feel free to reach out to him. I will say that I, just as a personal thing, I worked, had Clark kind of talk through some stuff with my family, and it was so very useful to have all those different perspectives that he has to offer. Really helped us in terms of how we planned, and so he definitely is worth a conversation if you're looking for that type of thing. So thank you very much.